Chat with Anurag Singh about the global mood. Anurag, hi, morning, good to have you on the show. Anurag, all this while we were working with a 25 bips cut and so were the global markets, but seems like traders are divided. I mean, looking at the CME Group's Fed Watch tool, it seems that traders are pricing in even a 50 bips cut and 63% of them.
Yeah. So, Aisha, morning. No, correct. I heard the conversation, and I think Kunj is kind of bang on dot. There is no need. I mean, traders can do what they want. I mean, they've been pricing it like pricing 6 rate cuts for this year. Ever since like December 2023 onwards, right? And then they took a whole U-turn, and now they're back there. So, look, let me give you 3 points why Federal Reserve should not be in a hurry. One is look at the Atlanta Fed GDP Now tracker. Now that has just inched up to 3% for this quarter, which means GDP and the economy, and on a base of a $28 trillion nominal economy, 3% growth is huge. So there's no worry on that front. Second is, look, the market 10-year yield is 3.65%. Which means the market is already doing the job for the Fed, right? Everything, all the loans out here, consumer loans, auto loans, and even home loans are indexed to the 10-year bond yield. So as long as that's at 3.6 to 3.8%, the job is already done. The conditions have already eased off. And third, finally, all said and done, these rate cuts are like bullets Federal Reserve has. And finally, if you look at their dot plot, eventually they want to get to like a 3% by end of 2026, which means that all they have is like 9 bullets. Why would you want to waste 9 bullets by firing 2 in a row just at the start and just kind of mislead the market? So I think all of this together, makes me believe that it'll be 25 basis points, but with a lot of dovish talk. I think Chair Powell will have a lot of dovish talk to do tomorrow. And I think that's about it. That's where my head set in, and I think that's how it's going to be, unless we all get surprised tomorrow. So never say never.
Okay, Anurag. So are you with? So you and me on the same page that there could be a sharpish comeback in commodities, looking at the data points, and if one look at historical patterns here. I'm just sounding repetitive with this one because I'm just trying to think through it, that when was the last time we had these patterns at play or these factors at play, and then what happened after that?
Correct. So let me give two, by the way, we talk commodities. Let's keep oil separate. Let me just give a quick take. The real price of oil will settle only after U.S. elections. Until then, U.S. is pumping close to 14 to 15 million barrels a day, which is like the unprecedented volume in kind of more than a decade or more than that. Actually, it's the highest ever oil production in U.S. And then U.S. is overlooking all the Iranian oil and Venezuelan oil and everything that is flowing across the border. So I think let's keep oil separate. Gold, we all know it's now an open secret that central banks are kind of trying to buy as much gold as a hedge to the dollar. So that's kind of in a decadal run. Outside of this, all the metals, because my sense is all the indexes are actually deceiving, because all the past patterns of, copper and ferrous and non-ferrous metals, they were hugely driven by demand from China. And as long as we are not sure how the Chinese economy is going to pick up, I think the peak demand is kind of behind us. So I'm kind of a little bearish on all these ferrous, non-ferrous metals. The only thing to be bullish out here is gold and oil after the elections. That's my take. I mean, I might be wrong. It's so hard to predict. But all these predictive leading indicators about metals really are very confusing these days.
All right, Anurag, thanks so much for giving us your assessment as to what we could expect.
If you like this video, then like, share and subscribe to ET Now.